The banking crisis, it's getting worse and it is triggering a global dollar shortage. Now, the contagion has spread beyond the United States and we have banks in Europe feeling the pain. They know that if another bank run happens, more banks beyond Credit Suisse could be in deep trouble. And to preempt this, central banks, they are dumping their US bonds to access dollar liquidity. They need cash on hands. Central banks today have shed their treasury holdings in the largest weekly decline since 2014. The foreign official holdings fell by $76 billion in a week, bringing the total down to just 2.86 trillion. But that's not all. Central banks are also using the Fed's foreign repo facility to access $60 billion. And we can see a huge spike here that dwarfs the 2020 borrowing peak of only 1.4 billion. And this tells us that banks are getting nervous. They are dumping US bonds because they need liquidity fast and are in a mad scramble for cash. And this is where the dollar strikes back again. Because the euro dollar market is just so big, foreign banks outside of the United States conduct a huge amount of business in the reserve currency. In fact, it is estimated that foreign banks actually hold up to $65 trillion in unrecorded dollar debt. And that is a bubble just waiting to be popped, especially if a dollar shortage gets worse. And this is the shadow banking system that everyone is terrified of an implosion happening. And across the world, over 60% of global debt is issued in dollars as well. So banks need to hold a huge pile of greenbacks because their depositors transact in dollars. They borrow and lend in dollars, not just their local currency. And we know what happened back in 2022. As interest rates rose, the reserve currency actually strengthened. And this caused a global dollar shortage as investors ran towards dollar assets to chase yield. But another deadly shortage is building, and it's thanks to the banking crisis that's going international. There's headline after headline of the dangers of hidden leverage that was built up during the era of low interest rates. And just so we know how big this bubble is, according to Bloomberg, the assets held by non-banking financial institutions are reaching $250 trillion. And that is a disaster just waiting to happen. And we gotta realize that this banking crisis is likely more severe than what the people at the Fed or the Treasury are telling us. And we can see the Fed's balance sheet increasing by over $400 billion, telling us just how much money they have pumped into the banks to keep them afloat. Just look at the bank term funding program. More banks are beginning to get desperate and they have accelerated their lending from the emergency backstop. It went from just $12 billion to over $54 billion in just a week. But things are getting from bad to worse because this fear is spreading to the point where foreign holders of treasuries are dumping it for cash and knocking at the Federal Reserve's door for loan. Not only are banks dumping treasuries and eating a loss, one mystery central bank, which is likely European, made a mad scramble for dollars. They went to the Fed's FEMA facility to borrow money. Now, FEMA, which is the foreign repo facility, acts just like a glorified pawn shop. It is the Federal Reserve's international borrowing window. Basically, a foreign central bank would pledge their US treasuries to the Federal Reserve in order to borrow US dollars. And this is a temporary measure to get access to liquidity because they need to shore up their balance sheet. A bank run is always around the corner, but this facility isn't free. You still need to pay interest on the loan, and this was at 4.75% before the Fed did their quarter point rate hike a week ago, so it's probably around 5% or more today. And we have a central bank somewhere in the world hoarding US dollars because they are afraid of liquidity crisis back home. It could have been the Swiss National Bank or maybe it's the ECB as well, preparing for the worst just in Europe. And after the Deutsche Bank sell-off last week with a 14% drop, something could be shaky in the European banking system. And here's the interesting thing. The Fed essentially is becoming the lender of last resort to these central banks because the dollar crisis might be silently building and only the Federal Reserve can print dollars from thin air. But understand the desperation that's going on here. Central banks, they are caught between a rock and a hard place. They need dollars, but if they outright sell their treasuries, they will book a loss. And countries like China, they are getting rid of their US bonds, but it's mainly due to the risk of sanctions and their de-dollarizing, so taking a hit might be a necessary evil. But for countries like Switzerland, there's very little incentive to book an outright loss on US bonds. It's better to hold the bonds to maturity. So they pledged their treasuries to the Fed in exchange for $60 billion worth of loans. And guess what? The US government is more than happy to give them the loan. If a central bank was to dump US bonds on the open market, this would cause yields to spike higher and bond values to crash even further. And that itself could trigger another bank implosion from bad treasury bets. And they definitely don't want that. The biggest problem banks face is that their cheapest source of funding is literally running away. Depositors are their cheapest source of money, and that means you. And let's recap banking 101. When you deposit money to a bank account, they give you a low interest rate, like 0.5% or so. They then lend out your cash or invest it for higher yield and pocket the difference. And even today, interest rates are around 4% in banks, and that is still considered cheap money, a discounted source of funding. And why is that? Because the banks can just take your money and throw it into the Federal Reserve's reverse repo facility that pays them 4.8%. So essentially, you are funding the bank with cheap money. But now depositors, they are freaking out about keeping too much money in the bank. Everyone in the world has heard of the US bank runs, and they know their options. What is the point of putting my money in a savings account when I can simply shift my cash into a money market account? There's no point keeping anything above the deposit insurance limit, right? And according to the Financial Times, money market funds have swelled up by more than $286 billion as investors pull away their deposits from banks. Then this is only going to get worse. We have Goldman Sachs forecasting an insane $1.1 trillion dump in stocks, with the cash moving to money market funds as well. The incentive is just too great, and this is going to keep the banks in crisis mode. Now, money market funds typically invest in shorter term treasury bonds, and because we have a yield curve inversion thanks to a recession coming, the yields on the 3 to 6 month treasuries are phenomenal at nearly 5%, and that is a risk-free rate. And that's why we are seeing so much money leaving the banks. It's not just because of the deposit panic, but also because the banks themselves can't compete and give a better rate than the US Treasury. And if we shift attention back to the US, this cash shortage is just as severe for American banks as well. Now the Federal Reserve is considering expanding the emergency lending facility to give banks more support. And this lets us know the true magnitude of the banking crisis. Shares of First Republic jumped by almost 12%, and the rest of the regionals have also recovered because shareholders realized that, hey, the US Treasury isn't going to let any banks fall now. Even First Republic might have become too big to fail. And remember when we said Janet Yellen is trapped after saving both SVB and Signature Depositors, she has almost no choice but to save everyone now, and that means loaning even more cash to the banks. Yellen, she is scared of a credit crunch because if it happens, it will slow down the entire economy and prices are going to crash across the board. And when companies can't borrow and expand, they lay off workers. And when people are too scared to sign a mortgage, housing prices also collapse. The entire system is dependent on credit flowing. It is the lifeblood of the economy. And according to the Fed, this banking crisis is bringing the United States closer towards a full-blown recession. In the Face the Nation interview, Kashkari from the Fed made a shocking admission that a credit crunch is already developing. We have seen the capital markets have largely been closed for the past 2 weeks. If those capital markets remain closed because borrowers and lenders remain nervous, then that would tell me this is probably going to have a bigger imprint on the economy. And we are now facing an economic reality. If the banks aren't lending money, this means the money supply isn't expanding, it's actually contracting. Existing money is being used to pay off existing debt obligations. And it's going to lead to a collapse in the economy because now money is not flowing around anymore. This is going to cause even more demand destruction, which is exactly what the Federal Reserve wants. Kashkari added how the banking crisis could actually help the Fed control inflation. On one hand, such strains could then bring down inflation, so we have to do less work with the federal funds rate to bring the economy into balance. So yes, he is pointing out the obvious that if a banking collapse happens, then the system freezes up and inflation should come crashing down. But it's not just the US that's on a credit crunch watch. Europe is also afraid of one. The ECB has effectively gone from negative interest rates to 3%, so the borrowing costs there have increased by a bigger margin as well. And if a credit crisis comes, the Federal Reserve might have to revisit the '08 plan and inject capital directly into the markets, and this will trap us further into an inflationary hell. And this brings us to the big vulnerability that the US banking sector has, which is the bond market. We have seen the destruction higher yields are causing to a world addicted to low interest rates. And who has the leverage during this banking crisis? Weirdly enough, it is actually China. And let's have a flashback to 2008 during the housing crisis. According to Hank Paulson, Russia approached China to coordinate a dump of mortgage-backed securities back then. They wanted to shake the US capital markets and force an emergency bailout to weaken the US dollar further. The Chinese, they refused to do it, so the American mortgage crisis didn't get worse. And don't get me wrong, '08 was bad, but it could have gotten much darker if the Chinese dumped their bonds then. But the relationship between the US and China isn't as rosy as before. Biden is downplaying deepening Russia-China ties, but we all know what's going on. Putin and Xi, they are moving towards a closer economic alliance, and it definitely isn't good news for the banking crisis if a sudden treasury dump happens. Now, China has already been unwinding their US bond holdings month after month, going below $860 billion. They are now back to the 2009 levels, and they probably won't be buying more anytime soon. And recall the plan that Putin himself has committed. He is moving to switch to the Chinese yuan in foreign trade. In other words, he is helping China to internationalize the yuan, especially if he starts pricing Russian energy in the currency. There are fewer incentives for China to hang on to their dollar assets, and even if they don't dump it all at once, a gradual deleveraging is going to keep bond yields higher back in the US, which is terrible for the banking crisis, which is on the brink. So the situation of this banking crisis isn't good. The deposits held by small US banks have dropped by a record 119 billion down to just 5.46 trillion. Now that's just a 2% capital flight away from the banks. But what if that number jumps to 3% or even 5%? Will it trigger yet another bank failure? Because if that happens, the US government is going to step in again and save the banking system. As we have said before in previous videos, it probably won't be a cash injection to prop up each individual institution, unless of course it is a too big to fail bank. It will be assisting a banking consolidation or takeover like what happened between UBS and Credit Suisse. And what do you know? SVB is finally sold to First Citizen, but only because Janet Yellen is providing a backstop. And how much money was this assistance? We are talking about $20 billion from the FDIC to cover the uninsured deposits. So it's going to be backstop after backstop, bailout after bailout, because the US government can't afford to let the US banking sector fail. It has to be a controlled demolition. But if foreign holders of treasury start to dump more US bonds because of a dollar shortage, this isn't going to be good. All it takes is for another bank to fail, and we could enter a crisis of confidence where more bank runs happen, triggering a credit crunch. And this is the interesting thing. We already have hedge funds selling off their oil-related futures and options contracts because they are preempting a recession. They foresee a credit crisis that will slow down the US economy. And if a recession happens and money stops flowing, then oil consumption should crash as well. So if the big money is anticipating a credit crisis, we have to pay attention to this. But let me know what you think in the comments below. Is a credit crisis coming? Are more central banks gonna dump treasuries to raise cash? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.